Coinbase's CEO just dropped a wild $1 million Bitcoin prediction, and it's not just hype. He's pointing to the U.S. government creating a strategic Bitcoin reserve and big institutions getting ready to pour money into the market. At the same time, a massive rotation is happening, with billions flowing out of Bitcoin and into Ethereum ETFs. All of this is happening while the entire market holds its breath for a potential Fed rate cut in September, which could send risk assets flying. With projects like Cardano and Chainlink being eyed for their own ETFs, you have to wonder, is this the setup for the biggest altcoin season we've ever seen? Or is it just a massive shakeout before the real move? In the latest video from Altcoin Daily, the main topic is a very strong prediction from Coinbase CEO Brian Armstrong, who believes Bitcoin will reach $1 million by 2030. He's not just guessing. He points to some serious developments. For one, he says the U.S. government is now establishing a strategic Bitcoin reserve, a move that would have seemed crazy just 5 years ago. He also notes that big institutions are currently holding about 1% of their portfolios in Bitcoin, but are ready to increase that to 5% or even 10% as soon as there's clear regulation. Armstrong reveals that Coinbase is already providing services to 140 different government entities, showing just how deeply crypto is becoming integrated. The conversation then turns to what's happening right now in the market. The video shows a big rotation of money from Bitcoin to Ethereum. According to crypto expert Leah Wald, Ethereum ETFs have attracted $3 billion this month, which is 16 times more than Bitcoin ETF flows. This isn't driven by small investors, but by institutions repositioning to get a piece of Ethereum's yield potential. This trend is also seen as a positive sign for other quality projects like Solana, which is positioning itself to be a world's marketplace with its low fees and high speed. Finally, Anthony Pompliano offers his take on the current market, saying Bitcoin is oversold and that people shouldn't sell now. He expects activity and prices to start picking up again around September and October. Brian Armstrong's $1 million Bitcoin call is the kind of massive statement that really gets the market talking. It feels like both a genuine conviction and a smart way to signal confidence to the big money players he mentions are waiting on the sidelines. The idea of a strategic U.S. Bitcoin reserve is particularly interesting because it shifts Bitcoin from a speculative asset to something with national level importance. The rotation into Ethereum makes perfect sense from an institutional viewpoint. While Bitcoin is digital gold, Ethereum is a productive asset with its yield, and that's a language Wall Street understands well. However, this whole bullish scenario seems to hang on the promise of regulatory clarity. We've been hearing about that for years, and while things are moving forward, the pace is slow. It feels like all the pieces are on the board for a major market shift, but the timing is still very much up in the air. In the latest video from the Crypto Rover channel, he gives a quick update from his car about some major market-moving news. Jerome Powell's recent speech has everyone talking because he signaled a rate cut could be on the table for September. Powell pointed to job risks and a cooling labor market in the U.S., suggesting that any inflation from tariffs is probably just temporary. This is exactly what the market wanted to hear. It's not surprising to see the market react so strongly to Powell's words. For risk assets like crypto, the possibility of a rate cut is like pouring gasoline on a fire. When the Federal Reserve makes it cheaper to borrow money, investors often move into assets that promise higher returns, and Bitcoin and Ethereum are top of that list. The idea that Ethereum is outperforming Bitcoin is a narrative that tends to gain steam late in a bull cycle. It often suggests that investor confidence is high, and people are willing to take on more risk with altcoins in search of bigger profits. Right now, it feels like the entire market is hanging on every word from the Fed, just waiting for the green light to go full risk on. In the latest video from the Crypto Tips channel, the host connects some troubling economic signs to the growing need for cryptocurrencies like Bitcoin and Monero. He kicks things off by talking about a potential government rule to track cash transactions as small as $200, which he sees as a huge push towards stablecoins and ultimately CBDCs. This is why he's a big believer in privacy coins. The host's argument is built on a foundation that many in the crypto space share. Macroeconomic decay is Bitcoin's primary use case. His comparison of housing costs from 1960 to today is a powerful, if simplified, way to illustrate the loss of purchasing power that official inflation numbers often fail to capture. While the M2 money supply has seen a slight dip from its peak in 2022, it remains astronomically high compared to pre-2020 levels, which supports his general point about currency devaluation. The analysis of Bitcoin's market cycles is a common practice, but it's worth remembering that past performance isn't a perfect predictor of future results. The introduction of spot Bitcoin ETFs has brought in new market dynamics that could potentially alter the timing and scale of these historical patterns. His perspective really frames Bitcoin not just as an investment, but as a necessary exit from a financial system he sees as fundamentally broken. In the latest video from Lark Davis, he cuts right to the chase on how to find altcoins that could make you serious money, especially with signs pointing towards a possible altcoin season. He notes that while the altcoin season index is mid-range, the general trend is up, with Ethereum making gains against Bitcoin and Bitcoin's dominance looking topped out. The usual money rotation goes from Bitcoin to Ethereum, then to major altcoins. And right now, we seem to be in an ETH season. So he lays out 5 key things to look for when picking your coins. Lark's framework is a solid mix of classic crypto speculation and newer, more mature market indicators. The idea of following the money through ETFs and corporate treasuries feels particularly relevant for this cycle. It's a clear shift from previous bull runs, where institutional interest was more of a whisper than a roar. Now, it's a quantifiable force that can genuinely move markets. The point about buybacks and real revenue is also becoming a bigger deal. It seems like investors are getting smarter, looking past pure hype and demanding projects with sustainable economic models. While meme coins and the attention factor will always be a wild part of crypto, the projects that combine that hype with actual, provable revenue streams, like he mentions with Hyperliquid, are the ones that seem best positioned to survive and thrive long-term. It's a sign the space is slowly but surely growing up. In the latest video from Ben Cowan, he breaks down the return on investment for Bitcoin's market cycle to get a feel for when this cycle might peak. He looks at it from 3 different angles. First, measuring from the market bottom, we're currently on day 1016. The last 2 cycles topped out around days 1059 and 1067, which points to a potential top sometime in October. He also points out a strange pattern where Bitcoin tends to stall at prices involving the number 124, like $1,242 in 2013 and about $12,400 in 2020. The second way to measure is from the halving event. We're on day 489, and previous cycles topped between 525 and 546 days after their halvings. This also suggests a top could be coming in the next few months. The third, and as he says, more dubious method, is measuring from the last cycle's peak. By this count, we're on day 1382, while previous cycles ended around days 1423 to 1473. A running theme through all these charts is the idea of diminishing returns. Each cycle's ROI is smaller than the last. He also notes how Bitcoin has a habit of getting ahead of schedule, stalling for several months, and then continuing its upward move, a pattern we've seen play out again this cycle. Ben Cowan's data-first approach is always a steady way to view the market, relying on historical patterns that have held up surprisingly well over time. His take on diminishing returns and cycle timing makes a lot of sense. However, this cycle has a major variable that past ones didn't: the massive inflow of institutional money through spot Bitcoin ETFs. This new dynamic is a real wild card. On one hand, this steady demand could stretch the cycle out longer and lead to a less dramatic peak than we've seen before. On the other hand, it could also mean that the smart money is far more efficient now, potentially leading to a sharper and more coordinated sell-off once they decide the top is in. While the historical charts provide a fantastic roadmap, the ETF variable makes this particular journey feel a bit different from the rest. In the latest video from the Coin Bureau channel, Nick gives us an update on Chainlink, a project they haven't covered in depth for over 3.5 years. He explains that while Link's price didn't do so well in the 2021 bull run, it was because the team was likely selling tokens to fund a massive development push. That investment is now starting to bear fruit. The video does a solid job of laying out Chainlink's strategy, which is basically to become the essential bridge between traditional finance and the blockchain world. This isn't just a theory, we're seeing it happen. For instance, the global financial messaging network SWIFT has been conducting experiments using Chainlink's CCIP to connect traditional banking systems to various blockchains. When a giant like Swift is testing your tech, it adds a whole new level of credibility to the project's vision. It makes the idea of Chainlink becoming the go-to standard for interoperability feel much more real. While the video correctly points out that TradFi could try to build its own solutions, Chainlink has a huge head start and a powerful network effect that will be tough for any single institution to replicate. The $70 price prediction might seem optimistic, but if these institutional partnerships keep stacking up, it's not out of the question. In the latest video from Crypto's Russ, the main focus is on the big Jackson Hole conference and what Fed Chair Powell might say. There's a lot of uncertainty right now because a couple of Fed governors, like Schmidt from Kansas City and Hammack from Cleveland, have suddenly started sounding hesitant about cutting interest rates in September. This goes against what everyone, including Powell, was previously signaling. The speaker points out that the economy isn't looking great, with jobless claims coming in higher than expected and previous job growth numbers being adjusted way down. This data should be the perfect reason for a rate cut. The market is clearly nervous. This week alone, nearly $2 billion has flowed out of the Bitcoin and Ethereum ETFs as people sell off in anticipation of bad news. The speaker lays out two paths for tomorrow. If Powell sounds hawkish and suggests delaying or reducing rate cuts, the market could see a serious drop. But if he acknowledges the weak job market and keeps a September cut on the table, we could see a nice bounce. He's personally holding a lot of crypto, but also has a boatload of cash ready to go, just in case. It's interesting to watch this video now, knowing how Powell's speech actually played out. The speaker captured the pre-event anxiety perfectly. The fear of a very hawkish turn was real, but Powell ended up walking a fine line. He didn't give the market the clear green light for a September cut that everyone wanted, but he also didn't slam the door shut. His message was basically, "We'll watch the data," which is a classic Fed move to buy more time. The market's somewhat muted reaction shows that while the worst-case scenario is avoided, the uncertainty the speaker talked about is definitely still here. We're not out of the woods, and the Fed is clearly still caught between tackling inflation and preventing a deeper economic slowdown. In the latest video from Crypto Wendy, she talks about why Cardano ADA is a project to watch, even with all the noise from meme coins. The main point is that projects with real utility, like Cardano, are strong candidates for a spot ETF approval in the US. When that happens, it could pour a ton of money into that specific coin and possibly kick off a real altcoin season. She notes that Cardano is currently ranked 10th on CoinMarketCap with a market cap of about $30 billion. The video makes a solid case for Cardano's long-term potential, especially tying its future to an ETF. It's an interesting perspective because most of the current buzz around Cardano is focused on its upcoming Chain hard fork. This major network upgrade is expected to completely decentralize its governance, which could attract even more developers and users. The rising TVL mentioned in the video seems to support this idea that activity is already picking up in anticipation. While an ETF would definitely be a huge catalyst, the network's own internal developments might be the more immediate story to follow. In the latest video from The Modern Investor, the host talks about the recent return of wild, unverified rumors in the crypto space. A major story started circulating that Japanese banking group SBI Holdings had filed for a dual-asset ETF combining Bitcoin and XRP. This news caused a lot of excitement, but it turns out it wasn't true at all. It's interesting how this situation perfectly captures the current mood in the crypto market, especially for XRP holders. The host is right. The community loves to piece together clues, and a potential ETF from a company as closely linked to Ripple as SBI is prime material for that. The rumor wasn't just pulled from thin air. SBI has a long-standing partnership with Ripple, so the idea itself makes sense. That's likely why it spread so fast. It's a classic case of wishful thinking meeting a vague corporate document. While this specific news was a dud, the real attention should be on the upcoming decisions for spot XRP ETFs in the United States. The approval of even one of those would have a much more significant and immediate effect on the market than a future plan from a Japanese firm. In the latest video from the Crypto Jeb channel, the focus is on Bitcoin's recent slump and what might happen next. Jeb starts by explaining why Bitcoin dropped from around $124,500. A couple of things spooked the market: higher than expected inflation numbers from the Producer Price Index, PPI, and news from MicroStrategy that they're pausing on taking out more debt to buy Bitcoin. This double whammy pushed the price down fast. It's interesting how the video separates the short-term trading jitters from the long-term investment picture. The focus on the $112,000 level makes a lot of sense. It's a major psychological and technical zone that many traders are watching. The narrative that short-term bad news is causing a technically driven sell-off, while the long-term story of institutional adoption remains intact, is a common theme in the current market. The idea that a drop could be a shakeout to liquidate leveraged traders before a major move up towards the end of the year feels plausible, especially with all the talk about ETFs and big money still flowing in. This tension between immediate price action and the bigger picture is what makes the market so fascinating right now.